All right. Well, good afternoon. My name is Darla Shaler. I am the events coordinator here at Lane Gorman Trubitt. I want to welcome you to today's webinar. All of our webinars are now open for registration, and you can check out the full list on our events page, which I will send in the chat momentarily. Today, we will be discussing Secure Act and Secure Act 2.0 and how your retirement plan is changing. For those of you joining for the first time today, Lane Gorman Trubitt is a mid-sized accounting firm for all business sizes. In 2023, LGT is providing endless opportunities to gain CPE credit. These events are created to help your businesses grow and thrive. We cover a broad range of topics that are impactful to businesses in the construction, M&D, dealer services, real estate, and not-for-profit industries. But we always want to make sure we're providing you with the topics you need more information about. So at the end of this webinar, you'll fill out an evaluation and please leave a comment with your suggestions about the topics you'd like to hear more about. This webinar will be available as a recording on YouTube within 2 business days following this event, and we will send a link to your email. If you have any questions about this or any of our services or would like to set up a free consultation, please send us an email at askus@lgt-cpa.com, and I will send that in the chat after this as well. This is a continuing professional education event, and you will receive 1 hour of CPE credit upon completion of the class evaluation. Following this webinar, you will receive an email from Prolera, our CPE provider, to fill out a survey and receive a CPE credit certification. Please take the survey to gain your certificate. Please submit any of your questions during this webinar to the Q&A function at the lower part of your screen, and we will answer your questions at the end of this webinar. So with that out of the way, I am excited to introduce Callie Lemle, LGT's Assurance Services Principal. Since joining LGT in 2014, Callie has brought a great level of enthusiasm and experience to her position at our firm. As a principal, Callie oversees the work performed by professional staff and serves as the primary link between the professional staff, engagement partner, and the client. During her time at LGT, Callie has continually developed knowledge in the employee benefit plans and manufacturing and distribution industries, which allows her to better evaluate and provide recommendations to her clients for enhancement of internal controls for the success of their business. Callie is also actively involved in research of new accounting and regulatory standards in order to appropriately advise and assist her clients with adopting and implementing the new guidance or legislation. Callie is the firm's resident qualified 401k administrator, or QKA, which allows her to better assess compliance for our 401k audit clients and assist with plan corrections and other compliance errors. So without further ado, Callie, take it away.
Thank you, Darla, for that introduction, and thank you everyone for joining us. I have been a little bit under the weather, so there may be some coughs, there may be a few sips of water taken, but it's only an hour, so I think I can make it through with you guys. Definitely want to get this information out to you over the Secure Act and the Secure 2.0 Act and how your retirement plan is going to be changing. So just a quick overview of the Secure Act. The first Secure Act it stands for Setting Every Community Up for Retirement Enhancement. It was part of the Further Consolidated Appropriations Act in 2020. It was signed into law December 2019. And then a few years later, the Secure 2.0 Act came out as part of the Consolidated Appropriations Act of 2023. And that was signed into law December 2022. So the goal of the Secure Act is simple: incentivize individuals to save for retirement and provide employers more ways to offer those benefits to their employees. The Secure 2.0 Act, it actually reconciled several separate bills that were floating around the House and the Senate. There was in the House, there was Securing a Strong Retirement Act, and there was Retirement Improvement and Savings Enhancement, or the RISE Act. In the Senate, they had the Retirement Improvement and Savings Enhancement Act to supplement healthy investments for the nest egg, or Rise and Shine Act. And then they also had the Enhancing American Retirement Now, or EARN Act. So they had all these separate bills floating around in Congress. It was very up and down whether it would get passed. At some points, it was taken off the docket and then put back on with some different provisions. The masses or the public, we had lovingly nicknamed all of these different bills as Secure 2.0 because it was building on that first Secure Act that came out in 2019. When it actually got passed, it was passed as the Secure 2.0 Act. So you might hear it called Secure 2.0 Act or Secure Act 2.0. Either way, that's just the second set of provisions that came out for the Secure Act. So these two Secure Acts have become two of the most impactful retirement legislation acts with wide sweeping provisions. The Secure Acts, they have provisions impacting all types of retirement plans, including defined contribution plans, your typical 401k, your 403b, your ESOP, defined benefit plans, health and welfare plans, individual retirement accounts or IRAs. Before these Secure Acts came out, the most recent legislation with a significant impact like this to retirement plans was the Pension Protection Act. And that was back in 2006. So there's about a 15-year spread there between these two really impactful legislations. So the Secure Acts, they include dozens of provisions with varying effective dates. Some are mandatory, some are optional. So to kind of put it in perspective, the Secure Act included about 30 new provisions, while the Secure 2.0 Act has about 100 new provisions. So we won't be able to cover everything today by any means, but I'd like to touch on some of the most impactful provisions that you as an employer would be interested in, as well as you as an employee for your employer to offer these type benefits for you. Like Darla said, the Q&A feature is open if you'd like to submit any questions. I'll take as many questions as I can at the end of the presentation, but we'll most certainly do individual follow-ups for any that I can't get to today. Okay, so we are going to start with some provisions related to contributions, or essentially how your employees get money into the retirement plan. So the first big one is going to be the long-term part-time employees. And I did see, just real quick, I did see a question come through. You will get copies of the slides. Darla will send those out after the presentation. This is also being recorded. And once that recording is ready, you will also get an email that the recording is ready for you. Okay, so long-term part-time employees or the LTPT employees. The Secure Act in 2019 came out with a 3-year rule. Employees who work more than 500 hours for 3 consecutive 12-month periods have to be allowed to participate in the 401k plan. So they have to be allowed to defer their own money into the plan. Those 12-month periods beginning before January 1, 2021 shall not be taken into account. So a long-term part-time employee would be eligible to participate beginning in 2024 if they met the 500-hour requirement in each of 2021, 2022, and 2023. And that's based on a typical calendar year-end plan where your plan's year-end is December 31st. So with these, many plans require an employee to complete a year of service, often defined as 1,000 hours in any given plan year in order to be eligible to participate. For part-time employees, this service requirement would generally exclude them because a lot of part-time employees aren't going to meet that 1,000-hour requirement in any year they work, and so those employees never get to save for retirement. So this LTPT rule is designed to address that in plans. So let's say your plan doesn't have a service requirement. Employees can participate as soon as they're hired. In that case, there's not going to be a lot of change for you because those part-time employees are already allowed to participate. Otherwise, this would require some tracking of hours beginning in 2021, 2022, and 2023 to see if those part-time employees should be allowed to defer come January 1, 2024. This is a mandatory provision. It's effective for plan years beginning after December 31, 2023. So 2024 would be that first year that those LTPT employees will have to be allowed to participate. So what the Secure Act 2.0 did was come out with a 2-year rule. And that's employees who work more than 500 hours for 2 consecutive 12-month periods have to be allowed to participate in a 401k plan or a 403b plan. The 3-year rule was only for 401k plans. This 2-year rule is 401k or 403b plans. So the 12-month periods beginning before January 1, 2023 will not be taken into account. So a long-term part-time employee would be able to participate beginning in 2025 if they met that 500-hour requirement in both of 2023 and 2024. A lot of people think that the 2-year rule from the Secure Act 2.0 replaced that 3-year rule from the first Secure Act, and that's not the case. This rule does not override the provisions of the Secure Act's 3-year rule. So the 2-year rule, it's mandatory as well. It's effective for plan years beginning after December 31, 2024. So for those 2025 calendar years. So essentially, you kind of have 2 rules going on here. For a 401k plan, if you have to allow these LTPT employees into the plan beginning in 2024 if they met that hours requirement for 3 preceding years. For 401k and 403b, you've got this 2-year rule that you have to allow these employees to participate in 2025 if they met that hour requirement the preceding 2 years. So you've got 2 sets of rules to keep up with on this LTPT rule. There are some provisions that are the same under both the rules. So if your plan has an age requirement, that age requirement still has to be met by the end of that relevant consecutive 12-month period. Employer matching contributions aren't required for the long-term part-time employees, but the employer can elect to provide them if they want to. Employers can also elect to exclude the LTPT employees from the coverage and non-discrimination testing. That includes the ADP and the ACP test. So what do you need to do as an employer? This is probably one of the most administrative, task-heavy provisions of the Secure Act. And employers should start those administrative tasks to identify their LTPT employees now. Make sure your hire dates and your hours worked are properly tracked for part-time employees in your payroll system. If you switched payroll systems recently, you would need to make sure that you have that information from your old system. Notifications would have to be made to the LTPT employees that they're eligible to participate and what dates they can start deferring. You should also consider whether you want to match those contributions, as well as consider hours tracking for vesting purposes on that. If the administrative burden of tracking the LTPT employees seems too cumbersome, you can also evaluate your plan design and whether allowing all employees to enter the plan for purposes of making deferrals immediately upon hire would be worthwhile. And then again, if that's already how your plan is designed, there's not much to do on this one. So that one might not be too bad for you guys. I did see a question come in whether these provisions on the LTPT employees are based on company size, and they are not. They are actually, this is applicable for any size plan. Okay, so some items about automatic enrollment. There is a new cap on the auto escalation. So previously, plans with an automatic enrollment feature, they could also include an auto escalation feature, whereby the initial deferral rate that someone's automatically enrolled in, it's increased by 1% each year, and that can be up to a maximum of 10%. The Secure Act increases that maximum cap to 15%. So this is optional, and it's effective for plan years beginning after December 31, 2019. So the plans, you could have implemented this optional provision since 2020. The 15% maximum is not required. Auto escalation is typically not required. But the 15% max, it's not required. Employers can select any deferral percentage as their cap on the auto escalation feature, as long as it does not exceed 15%. And with automatic enrollment with auto escalation, employees can always elect otherwise. So if they don't want their deferrals increased by 1% every year, they can just make an alternate election there. Another thing from the Secure Act is mandatory automatic enrollment for new plans. So all newly established 401k and 403b plans are required to include an automatic enrollment feature with auto escalation. The initial deferral rate, it has to be at least 3%, but not more than 10%. And then the auto escalation feature has to increase that rate by 1% up to at least 10%, but not more than 15%. Employees can always opt out or make a different election. And in this case, newly established plans means established on or after the enactment of the Secure 2.0 Act. So that would be established on or after December 2022. So any plan that was established prior to the enactment of this act would be excluded from this requirement. So if your plan was already in existence before December 2022, you don't have to do this. I know there was kind of a big upheaval when this first came out because it wasn't clear whether all plans in existence would have to have this automatic enrollment, and that is not the case. If you existed prior to the enactment, you do not have to do this. There's also some additional exceptions. So if you are a new business where you have been in existence less than 3 years, or small businesses that are 10 or fewer employees, you would not be subject to this mandatory automatic enrollment. Okay, emergency savings accounts. So the Secure 2.0 Act, it allows an emergency savings account or an ESA to be established and linked to a participant's retirement account in an individual account plan, such as a 401k or a 403b, a plan where an employee has their particular account balance in the plan in their name. Contributions to the ESA have to be designated as Roth or after tax. The contribution limit is $2,500 per taxable year. If an employer offers a match under the plan, the employer must also match the employee's ESA contributions, but that match would be made to the individual account, not the ESA. So only the employee's contributions go into the ESA, but the employer does have to match that amount into their regular plan. And the ESAs will not be available to highly compensated employees. Your highly compensated employees, they can be identified through meeting one of two tests. Either they're a 5% owner at any time during the current plan year or the preceding plan year, or that employee exceeds the designated compensation threshold for the preceding year. So for 2023, that compensation threshold is $150,000, but it can be adjusted annually for cost of living adjustments. So allowing emergency savings account in your plans, that is optional. It would be something that the employer would elect to add as a plan provision. And you can start adding that optional provision in for plan years beginning after December 31, 2023. Some things about employer matching. So currently, employer matching contributions and non-elective or profit-sharing contributions, they are made on a pre-tax basis. The Secure 2.0 Act provides an option for employers to designate those contributions as Roth or after-tax contributions. Student loan payments. This allows treatment of student loan payments as elective deferrals for purposes of matching contributions. So it's important to note that the student loan payments, they're not counted as elective deferrals or employee contributions to the plan. The student makes the loan payment as usual, but the employer contributes a matching amount to the plan. The idea behind this is employees who are making student loan payments typically don't also contribute to a 401k plan. They just might not have the means to do both. So this allows that employee to have something going into retirement from their employer as they make those student loan payments. The employee has to certify to the employer that the payments were made on qualified student loan, and the employer can rely on that certification. The employer can elect to make a matching contribution on the amount of the student loan payments in the same manner they would match elective deferrals, so it's the same formula. Vesting would be the same as the normal employer matching contributions. So this is optional. It is effective for plan years beginning after December 31st, 2023. We did have a question come in on the previous slide about the Roth designated employer matching contributions, whether those are deductible or non-deductible to the employer. I am happy to follow up on that with you and get you some more information on that one. Okay, so catch-up contributions. There will be a higher catch-up limit that will be applied at age 60, 61, 62, and 63. So for participants who would attain age 60, but would not attain age 64 before the close of the taxable year, the limit on catch-up contributions will be the greater of $10,000 or 150% of the standard catch-up contribution amount for 2024. That $10,000 amount will be adjusted for cost of living adjustments annually. The change in the catch-up limit is mandatory to be made by the IRS. However, allowing your participants to make catch-up contributions in your plan, that is optional. That depends on your plan design. And then whether an employee wants to make catch-up contributions or not, assuming they're of age, that's optional to the employee. So as an example, the 2023 catch-up contribution is $7,500. 150% of that would be $11,250. So assuming that catch-up limit stays the same for 2024, which typically it increases a bit, a participant who is age 60 to 63 for the 2025 taxable year could contribute $11,250 in catch-up contributions instead of the normal $7,500. So the limits will change. That's a mandatory change by the IRS, and it's going to be for taxable years beginning in 2025. And then one more thing on the catch-up contributions is designated Roth catch-up contributions. For participants eligible to make catch-up contributions and whose wages in the preceding calendar year exceeds $145,000, those catch-up contributions have to be designated as Roth or after-tax contributions. The $145,000 threshold will be adjusted annually for cost of living adjustments. So this is a mandatory change. It is effective for taxable years beginning after December 31, 2023. Okay, so some provisions about distributions. So as many provisions as the Secure Act included about new ways to contribute, they've got new ways to distribute. So the big one is going to be the required minimum distributions. Prior to the Secure Act, required minimum distributions, or RMDs, were required when a participant reached the age of 70 and a half. The Secure Act increased that age to 72. That was effective in 2020. The Secure 2.0 Act increases that age to 73 in 2023 and increases it to 75 10 years later in 2033. So these are mandatory changes. You will need to pay attention to these, as well as your third-party administrator, when making distributions, when determining who needs a required minimum distribution, and really paying attention to their ages and what the applicable age is for that year. Mandatory distributions. So prior to the Secure 2.0 Act, mandatory distributions or involuntary cash outs of vested account balances for terminated participants could be made without the participant's consent, as long as the amount did not exceed $5,000. The Secure Act increases that mandatory distribution limitation from $5,000 to $7,000. So this is optional. So if you have a plan provision in your plan that has mandatory distributions and involuntary cash outs, yes, the cash out is mandatory, but what you set that amount as doesn't have to be $7,000. It could be something less. It just can't exceed $7,000. So it's the employer's election to require the mandatory distributions and to set the applicable threshold. So it is optional for you to increase that to $7,000, but that is available for you if you elect to do so. And that would be for distributions made after December 31, 2023. Hardship withdrawals. So provisions of the Secure 2.0 Act clarified that employers can rely on a written certification from a participant that a requested hardship distribution is on account of an immediate and heavy financial need, the distribution is not in excess of the amount required to satisfy the need, and that the employee has no alternative means reasonably available to satisfy that need. So the written certification can be relied upon unless the employer has actual knowledge to the contrary. So although employers can rely on the certification, it's at your discretion if you want to require additional substantiating evidence. So for example, one of the hardship distribution reasons is for medical bills. The employee can certify to you that these are their medical bills or their spouse or their beneficiary or their dependent's medical bills, and this is the amount. And it's at your option to rely on that certification. Or it's also at your option to say, we would like you to provide medical bills for review for this distribution. So while you can rely on their certification, you do not have to if you want to require additional there. So that's going to be effective for plan years beginning after the enactment of Secure 2.0, so December 2020. Special tax relief was previously enacted, allowing employers access to their retirement funds to recover from disaster losses incurred while living in certain federally declared disaster areas. So the Secure 2.0 Act has provisions that those distributions shall not exceed $22,000. The amount can be repaid within 3 years. And while that limit on the distribution is mandatory, allowing such distributions in your plan is optional. So the limit is mandatory, and that's going to be for distribution for the incident period was after enactment, the Taxpayer Certainty and Disaster Tax Relief Act in 2020. Emergency expense distributions. This is another optional distribution you can add for your plan beginning in 2024. It's an emergency personal expense distribution or an EPED. The amount cannot exceed $1,000 in any given year. The employer can rely on the employee's certification that the amount is for an emergency personal expense. It can be repaid to the plan. And once an employee receives an EPED, they cannot receive another one for the next 3 calendar years unless the EPED has been repaid or the employee has put in additional elective deferrals that at least equal the amount of the original EPED they received. A birth or adoption distributions. This is another optional distribution you can add. You could have been adding these since 2020 or allowing these since 2020. It was part of the original Secure Act. So this is a penalty-free withdrawal for qualified birth or adoption distribution. The distribution can't exceed $5,000. The distribution has to occur during the 1-year period beginning on the date the child is born or the legal adoption is finalized. It may be repaid to the plan. The Secure 2.0 Act clarified that that repayment period is 3 years from the date of the distribution if the distribution is made subsequent to the Secure 2.0 Act being enacted. Because you could allow these since 2020, if you made the distribution prior to Secure 2.0, then that repayment period will end January 1, 2026. Another penalty-free optional withdrawal you can add is for a victim of domestic abuse. The amount shall not exceed the lesser of $10,000 or 50% of the participant's vested account balance. The distribution has to occur during the 1-year period beginning on any date the employee is a victim of domestic abuse by a spouse or domestic partner. It may be repaid to the plan, and the employer can rely on the employee's certification. Early withdrawal penalty modifications. The early withdrawal penalty has been updated from no penalty if over age 50 to no penalty if over age 50 or has 25 years of service, whichever is earlier. The early withdrawal penalty has been waived for distributions to individuals with a terminal illness. The employee has to furnish sufficient evidence to the plan administrator and be certified by a physician as having a terminal illness, and it may be repaid to the plan. These are mandatory changes. They are effective for distributions made after the enactment date of Secure 2.0, so after December 2022. Okay, so we have some administrative provisions that we want to go over. Financial incentives for employees. So the Secure 2.0 Act, it allows for employers to provide a de minimis financial incentive to employees to essentially encourage them to enroll in the plan. The amount cannot be paid with plan assets. It must be paid by the employer. This will not be considered a prohibited transaction, and de minimis is not defined in the Secure 2.0 Act. So there was a summary of the Secure 2.0 Act from the Senate that was released that included the words such as low dollar gift cards after de minimis financial incentives. However, the Secure 2.0 Act doesn't define de minimis. So people are looking to the IRS guidance for de minimis financial incentives or fringe benefits. And the IRS guidance says de minimis fringe benefits such as cash or cash equivalent items like a gift certificate are never excludable from income and therefore are not considered de minimis. So some examples of de minimis fringe benefits from the IRS include occasional snacks, coffee or donuts, occasional tickets for entertainment events, flowers, fruit, books, etc. Expansion of EPCRS. So EPCRS is the Employee Plans Compliance Resolution System. The Secure 2.0 Act directs the IRS to expand that system to allow self-correction for any eligible inadvertent failure to comply with the rules without reporting that failure to the IRS. Self-correction is not available if the IRS identifies the failure, such as through an audit, or if the self-correction is not completed within a reasonable period of time after the failure is identified. And reasonable period of time is not defined. Guidance is expected to be issued by the IRS for correction methods that are required to be used to correct eligible inadvertent failures to the extent such correction method is not already specified, and to hopefully define what that reasonable period of time for correction would be. So this is a mandatory change to the EPCRS system. The Secretary of the Treasury is tasked with revising Revenue Procedure 2021-30 to take into account these provisions not later than 2 years after enactment of the Secure 2.0 Act. So as of now, I don't believe that Rev Proc has been revised. Plan corrections for auto enrollment. So currently under EPCRS, if the plan has an automatic enrollment or auto escalation feature and there is an operational error, the plan sponsor does not have to make up the missed elective deferral as long as the error is corrected within 9.5 months after the plan year in which the error occurs, the mismatch plus the earnings is corrected, and a notice is made to the participant within 45 days. That notice does have to include certain specified things in it. So that extended time period to make a correction expires under EPCRS at the end of this year on December 31, 2023. The Secure 2.0 Act makes that extended correction period a permanent safe harbor. So if you have auto enrollment in your plan or auto escalation, and let's say you had a new employee, they were supposed to be enrolled, 3 months after their hire date, and that enrollment didn't happen. Let's say it was 6 months before you caught it, or let's even say 6 months after, into the next year that you caught it. So as long as you make that correction within 9.5 months after the plan year in which the error occurs, then you don't have to make up that missed elective deferral. So let's say the automatic enrollment is supposed to be 3%. You wouldn't have to make up the 3% that the employee should have been deferring in that time that you missed enrolling them. But you would have to make up whatever match would have been made on that 3% of employee contributions and the earnings. So that's going to be effective for errors where the date of the required correction is after December 31, 2023. Increased penalties. So these increased penalties were part of the original Secure Act. So these increased penalties, they've been in effect since 2020. The failure to file Form 5500, the old penalty was $25 per day with a $15,000 maximum. It has increased tenfold. It's now $250 per day with a $150,000 maximum. So when penalties are calculated for a late Form 5500, that penalty is calculated from the original due date of the return. So for a calendar year plan, that would be July 31st. Even if a proper extension to extend that due date to October 15th is made, that penalty is still going to be retroactive to that original due date. So even if you're 1 day late from the October 15th deadline, the IRS considers that return to already be 77 days late. The number of days from July 31st to October 16th, 1 day late that you file your return. So under the old penalty, if you filed on 1 day late, you would owe about $2,000. Under the new penalty, you would owe about $20,000 just for being 1 day late. So actually all of these penalties have increased tenfold. Failure to file Form 8955 SSA used to be $1 per day per participant with a $5,000 maximum. It's now $10 per day per participant with a $50,000 maximum. And that Form 8955 SSA, that's the annual registration statement that identifies separated participants with deferred vested benefits. So that's to report those people and amounts to the Social Security Administration. So when individuals retire, the Social Security Administration can inform those employees of what plans they may have retirement funds still in. This is a separate filing from your Form 5500. It does include Social Security numbers on it, and it's very important that you do not file that with your Form 5500 since the Form 5500 filings are publicly available. A failure to notify the IRS of a change in plan name or plan sponsor address, plan merger or division, or plan termination used to be $1 per day with a $1,000 maximum. It's now $10 per day with a $10,000 maximum. So the notifications of change in plan name, address, mergers, terminations, that's all information that's on your Form 5500. So if your Form 5500 is late, you've also failed to notify the IRS of these changes. There was also one more penalty increase, failure to provide the required notice to a participant receiving distribution that's not eligible for rollover regarding their right to waive federal income tax withholding. That used to be $10 per failure with a $5,000 maximum. That's been increased to $100 per failure with a maximum of $50,000. So literally all of these penalties have increased 10 times. And like I said, these were part of the original Secure Act. These penalties have been in effect since 2020. So it's really important to make sure all of these filings and notifications get made timely. So you're probably wondering, when do I have to make plan amendments to my plan document for all this new stuff? So although formal plan amendments have not been made, plans will be treated as being operated in accordance with the terms of their plan when applying provisions from the Secure Act. So assuming something from the Secure Act is mandatory to be done, you are expected to follow that even if you haven't formally amended your plan document. The Secure 2.0 Act specifies the deadline for plan amendments to be required for the last day of the first plan year beginning on or after January 1, 2025. So if you're a calendar year plan, you would have to make formal plan amendments by the end of 2025, December 31, 2025. So anything that's a mandatory change, anything that's optional that you elect to include in your plan, those amendments have to be done by the end of 2025. The Secure 2.0 Act also extended amendment deadlines for several other pieces of legislation. So the Secure Act of 2019, the CARES Act of 2020, and the Taxpayer Certainty and Disaster Tax Relief Act of 2020. It extended all of those deadlines to be in alignment with the Secure 2.0 deadline of 2025. So the CARES Act, that was a big one that a lot of employers elected provisions from. So that legislation allowed a coronavirus-related distribution that I believe could be up to $100,000, increased loan limits for COVID-19 affected participants. Those amendments were required by the end of 2022. That has now been extended to the end of 2025 in line with the Secure 2.0 Act. So it will be mandatory to make those plan amendments. But you do have some time. But either way, for the mandatory provisions of the Secure Act, you have to start applying them according to their effective date, regardless of if that plan amendment has been made yet or not. So it looks like we did have a question come in, whether the Act changed the age at which you must begin taking required minimum distributions. And yes, that is going to be in your slides let me just back it up to that here. It's going to be slide 17 in your slides, which will be coming out for you. But yes, several changes on the RMD age. It went from 70.5 to 72 in 2020, and then up to 73 in 2023, and then it will go up again to 75 10 years later in 2033. So lots of changes on the RMD age to keep up with there. So that's all of the provisions I wanted to cover from the Secure Act, but I wanted to cover one more thing with you, and that's kind of a side impact from the Secure Act, and that is your participant counting rule for the Form 5500 filings. So currently, if your employee benefit plan has 100 or more participants as of the beginning of the plan year, the plan is classified as a large plan and it has an annual audit requirement. The 100 participant count is determined based on any employee with an account balance in the plan, plus any employee that's eligible to participate but does not have an account balance in the plan as of the beginning of the plan year. So with the Secure Act changes to eligibility provisions, allowing those long-term part-time employees to participate, those participant counts are expected to increase because you're going to have more employees eligible to participate, regardless of whether they're actually participating or not. So a significant number of plans would become subject to an audit if the method of counting the participants to qualify for the audit waiver was not revised. So in response to this, the Department of Labor and the Internal Revenue Service have revised that participant counting rule. So under the revised participant counting rule, the 100 participant count will be determined based only on the number of employees with an account balance in the plan as of the beginning of the plan year. So this will reduce your participant count for the plan. And it may cause plans hovering around the 100 participant threshold to fall below that threshold and no longer need an audit. So let's back up and say, if you're a calendar year plan and you look at your participants on January 1, 2023, if you've got 95 individuals with an account balance in the plan, but you've got another 30 individuals that don't have an account balance in the plan, but they've met your age and service requirements to participate, you're considered to have 125 participants in your plan. And you would be considered to be a large plan, and you'd have to have a 401k audit each year. So under the revised counting rule, where you only had 95 individuals with an account balance and another 30 who were eligible to participate but weren't participating, your participant count under that revised rule is only going to be 95 participants. It's only going to be the individuals that have an account balance in the plan. So under the revised rule, this example plan doesn't meet that 100 participant threshold to require an audit. So they would be considered a small plan, and they qualify for an audit waiver, and they wouldn't need to have an audit for the 2023 plan year. So this change applies to defined contribution plans only. So it's going to apply to your 401k plans, your 403b plans, your ESOP plans, basically any plan that employees have individual account balances. The change is intended to reduce expenses for small plans and encourage more small employers to offer workplace retirement savings plans to their employees. So there will be cases where a plan is going to be subjected to an annual audit requirement for the first time in the 2022 plan year, but based on that revised participant counting rule that's going to go into effect in 2023, they may no longer need an audit. So the IRS and the DOL, they are not providing any exceptions for these cases. And they've made it clear that the 2022 audit must still be completed and will not be waived, even though the plan won't need an audit the very next year. So a pretty big change there that's going to be seen on that 2023 Form 5500. It's expected that a lot of plans out there will now fall below that 100 participant threshold and no longer need an audit. So if you are currently hovering around that 100 participant threshold, once you take out those employees that don't have an account balance but they're eligible to participate, you might be below it, and you might not need that audit anymore. So that is all I had for you there. I will open it up to any additional questions. Can the plan be audited even if you are not required to be audited? Absolutely. So if the employer wants to have an audit, that is absolutely at their discretion. We actually do have some 401k plans that still get an audit every year, even though they don't need one. And a lot of times that's just the employer wanting that extra check that things are running okay, and making sure that distributions and contributions are calculated correctly, and making sure they're in compliance with the rules and regulations and keeping up to date on everything. So you can absolutely have an audit even if you're not required to have one. Any other questions, feel free to submit them in the Q&A. And I've also included my email address here. So if you can't think of something now, but you think of something later, I'd be happy for you to email me and answer that one-on-one. Another question came through: if we were required to have an audit in the past and the threshold is lower now, do you not have to have one? That is correct. So even those plans that have historically had an audit because they've been over that 100 participant threshold, if under the revised participant counting rule, they now fall below that threshold, they no longer have to have an audit. It will no longer be required for them. Another question, whether the TPA generally files the Form 8955 SSA, that is the form with the Social Security Administration. There is a separate filing system for the 8955 SSA. I know the IRS typically, and DOL, they typically don't love to get those attached to Form 5500. Plus, it puts a lot of personal information out there to the public that really shouldn't be. The TPA, they may help in filing that. The TPA typically will help in filing the Form 5500, so they may certainly also facilitate that filing as well.
Well, if there are no further questions, or even if you did have a further question, feel free to reach out to Callie. You can reach out to her through the email right here or through the email that I put in the chat. At any time, we can answer those questions that you do think of. And remember, we will send the slides out either tomorrow or the day after, as well as with a recording of this on our YouTube channel. So be looking out for the survey so that you can get your CPE credit. And we thank all of you for coming. Callie, you did a great job. And we thank you so much for joining us for this webinar. Y'all have a great day.